Hello Proponomics people, in today's video I want to talk about the current unemployment situation in the UK and the labour market report from the ONS which has just been released. So why is this so important? Well, of course, apart from anything else, we want a healthy and productive economy. That includes people being in work rather than out of work, but also there are some thoughts on the other side. As the minimum wage gets pushed up and up in real terms, it has to affect unemployment at some point, of course, and it does mean that some jobs where it's difficult to produce any extra productivity become at risk, because ultimately you find yourselves as an employer or as a business looking for ways to, first of all, replace people with machines. Of course, that's been going on anyway, but it stands to reason that the higher the cost of the person, the more incentive there is to replace with a machine. With a machine, you're going to make a lot of capital expenditure up front. It's not necessarily dissimilar with an employee out of interest. If you're going to spend a lot of time training them, you don't expect them to be at their full productivity at the start of a job, but then with a machine, you're going to have service contracts and things like that. So you know the cost of all of that. Whereas at the moment, one of the things that businesses will be saying is, well, we don't know when the cost of all this stuff is going to go up. We thought inflation was under control, but actually person inflation, particularly pertinent in the services sector, which is the major sector in the UK economy, well, when is it going to stop going up? What will minimum wage rise be next year? First thoughts are 3.9%. If inflation is more robust, as I think it is, I'm sure we're going to see that nudged upwards, not downwards. And most surveys think that wages are going to be rising about 5% still by the end of 2024. That's a survey of businesses who should have a relatively good take on a lot of this stuff. And again, figures that were out in this report show that wages are still rising 6% year on year without bonuses. And this all feeds back into the inflation narrative, which I know I've been going on about for 3 years and 3.5 months now. But that's because it's important, very, very important, because apart from anything else, it's why the interest rate, the base rate of interest is set as it is. And it also informs the bond market and what the expectations are in the bond market of returns for international and national investors who invest in our government debt. So the report comes out once a month, always tends to be on a Tuesday. Often the second Tuesday. It depends on where the calendar falls, but that's where we are. It's always a big day. It moves markets as a general rule. It didn't move the needle much yesterday. What were the headlines? You all know by now, if you've listened to me talk about this at all, or you've read any of what I've written about this, everyone loves to focus on that unemployment number, 4.3%. Historically very, very low. 6% was seen as a watermark after the financial crisis, is when we got below 6%. The economy was really roaring and we were doing really well. There was even some forward guidance from Mark Carney that interest rates would start to go up when we got under that 6% threshold. That forward guidance didn't really play out and it kind of dissipated and didn't really talk about it much more. So an economy like the UK or the US, fairly similar, you would see these days about 3%-ish unemployment as basically full employment in the way that things are measured these days. And we need to be careful with that term. But what we're saying is everyone who wants a job has pretty much got a job. That 3% represents people who are moving around, frictional unemployment, changing jobs, life circumstances change, all those sorts of reasons. Moving geographies, it takes time to move from X to Y, perhaps splitting from a partner or getting with a new partner and geographically relocating, all those sorts of things. Around about 3% is a fair estimate for that. So both those economies, the US and the UK, have been down to 3.5% in recent times. Why might that be a bad thing is probably an interesting thing to address up front. Well, can be to do with productivity, as I say. So if the labour market is super, super tight, and that's what we've seen in both the countries actually in the past few years, the labour market's been so tight you've had to nearly employ anybody with a pulse if you've really needed someone to do a job. Otherwise, you've had lots and lots of vacancies hanging out there in the ether, sitting and waiting for the right person to come along. And employees have had a lot of power and they've used lots and lots of job interviews to leverage pay rises for themselves and things like that and not really moved across. And all of this is very, very inefficient for a company, of course, but it's the nature of the beast and I'm not blaming the employees. They've got to try and do the best thing they can for themselves. Of course they have. Now we're in a situation where the economy's changed a bit. We've had a technical recession. People are not so sure that it would be a great time to be moving jobs, but also you've got these significant cost increases. 9.8% going on the minimum wage means 11.6% for the employers in terms of the increase in their cost base of a minimum wage member of staff, because they've got pensions to think about and they've got employers' national insurance contributions to think about. So it's a big deal. So what are those employers going to do? As I say, they're going to look at ways of reducing headcount. They're going to look at efficiencies. They're going to look at things like that. Now, if we lose employment because of that, and that's where we're going at the moment, I'm not saying it's because of the minimum wage increase. It's slightly cyclical as well. We've had a recession. We've shed some jobs. There were hiring freezes last year. The first quarter of this year, we heard from all recruitment firms they're having a bad quarter. They've placed fewer people than they have done for years and years. The vacancies is down to the lowest number it's been since the pandemic, but the number is still higher than it ever was before the pandemic in terms of job vacancies. But people have now got to the stage where there's a few more people in the market. There's some engaged employees, some good prospects, and it means that any of the zombie employees they've been hanging on to because they haven't wanted to get rid of people because it's been so difficult to recruit, that attitude has changed. Redundancies start to go up. Performance management starts to go up. And therefore, unemployment starts to go up. As I say, not blaming the minimum wage for that, but you can't just put the minimum wage up indefinitely in real terms and not expect there to be any impact to that. That would be a foolish theoretical economic statement. If the minimum wage was £10,000 an hour, obviously it's self-evident that everyone would be out of a job. So we have to come back from there and think about the extremes. The minimum wage at £11.44 is in the market at making a difference. And when £11.44 is grossed up by all the other costs of having an employee, then ultimately it becomes more worthwhile sometimes to contract things out for a whole number of reasons for a lot of businesses. So that might mean fewer people on payrolls because the people working contracted out are possibly working gig economy, style shifts, 0 hours contracts, whereas they would have been employed. So it doesn't necessarily help as well in terms of stability of jobs. But there we go. So back to the tail of the tape. First of all, I've got to say there was a flash estimate in March that 65,000 people had come off payroll, 67,000, had come off payrolls. They revised that to 5,000 by the time they got to the figures. Now, this month's flash estimate for April, because these are the figures up to March, the end of Q1, the flash estimate for April is that 85,000 people have lost their jobs. But given that 67,000 became 5,000, let's see when we get to next month. I don't think we can really rely on that very much as far as real-time information goes. And this is why, one of the reasons, apart from anything else, why, so we've only got a 0.4% increase in the number of people on payrolls over the year, but we've finally got a bit of an increase in the economy. This is why Q1 was the first increase in GDP per capita for 2 years. So, productivity per head, or output per head, I should say, is obviously an important thing to measure. But you'll know the 4.3 isn't really the number that I love to focus on. In these situations, I like to look at actual employment and also those who are not in the market because of sickness and all the rest of it. We'll come on to that. And in terms of wage rises, they stuck at 6%. That was what they were than the month before. I look at them ex-bonus at the moment because the bonuses have been used to try and give people one-off bonuses for the pandemic. That still doesn't seem to have dropped out the figures yet because annual earnings, including bonuses, are only up 5.7%. Or bonuses have been frozen in order for employers to keep track of, to keep hold of all of their input costs, but they're having to put the base wage up. But I think the base wage is a better track. Ignore the bonuses. I'm not really sure if they're too relevant at this point or at any point too much. And so real terms pay growth, 2% for regular pay. That's if they adjust by CPIH, which the ONS prefer to use. Now, when that new measure, CPIH, comes out, which is now just about a week away when we get the inflation figures, we know it's going to be 2 point something for CPI, and I expect CPIH to follow. It'll still be perhaps 0.5% above where CPI is, but I'd be surprised if CPI was above 2.5%. I've thrown a dart at 2.4. A lot of people are saying 2.1. Let's see what happens, but that would still see CPIH below 3%. And with wages at 6 and CPIH at 2.9, even if it was, there's obviously a 3% rise in real terms. And then think about how this figure is going to change next month, because next month we'll have April's figures in, and April's figures will include, for some workers, a 9.8% pay rise, apart from anything else. And minimum and people pegged to minimum, which is probably around about 1/6 of the workforce on the best sort of data that we have, which is obviously a significant. I mean, if 1/6 goes up 10%, and the rest goes up as it has been, then we're going to see a print that looks more like 7%, not 6%. Which will really spook the bond markets, although we can see it coming. I find it strange that we're not reacting to it, but there we go. So, still 100,000 more job vacancies than there were in the quarter that ended March 2020. That's where we are, still 898,000. Yet real earnings going forward, that sort of 2% mark is a great marker for things to be going forward. That is going to go up though as we get into next month. Let's see what happens with the payroll. Not going to really make too much of a decision on that. 74.5% of all people employed. That's the metric that I prefer. So that's down 1.7. We were at 76.2. That's down 1.7% from before the pandemic and is pretty much going the wrong way. Why? Well, it's this massive increase in long-term sickness apart from anything else. The unemployment rate is around about where it was coming to the start of the pandemic. Inactivity rate 22, a massive 22.1%, and that's up 1.6% since before the pandemic. So that just tells us exactly where it is. Those who are, it's not like unemployment has changed particularly, it's employment that's changed, and it's people moved on to the not economically active side of things. And there's the danger. NHS waiting lists have to be considered as a big part of what's going on. So the ONS don't do a terrible job. They're pretty self-critical about their unemployment figures. They are looking at the number of people claiming job seekers allowance, universal credit, searching for work, things like that. They do count that sort of stuff. These real-time informations from PAYE that we saw, as I say, they've led to these flash estimates being revised by sort of 60-odd thousand people, which is not a small, it's like 0.2% of the workforce. It's not a small amount. Going to make quite a big difference if you're going to predict unemployment on the back of all of that. Although the consensus was 4.3, in fairness to the forecasters for once, who I'm normally pretty mean to, and they were spot on with the 4.3. I like the vacancies to give you a pretty good snap of what's going on, and they do have, of course, real-time PAYE information from HMRC as well, so they do a reasonable job. But generally speaking, there's an argument that 4.5% or so is sort of where we're going to get to this year at some point in unemployment, and that's not a bad thing for productivity, right? Because the least productive are the ones being shed if companies are working efficiently, and they're being driven to work efficiently because inflation is forcing them to work efficiently. But when we come back to the major narrative, when we consider inflation, interest rates ultimately, are they going to go down soon? Not on the back of 6% wage rises. And if people are right and the businesses are right in predicting that's going to persist to about 5% at the end of the year, and now we've got an economy that looks like it's going forward, we'd be surprised now not to see 0.5% growth in Q2. That'll put us on 1 point something for the year. These things don't tend to add up at the ONS for whatever reason that's beyond me, but it puts us in the north of 1% for the year. No one can argue that we'll be growing at that stage, annualised rate of over 2%, which I'm sad to say is a pretty great achievement these days in the UK. I would argue that most of this is actually coming from inflation control, because you have to remember that GDP is measured after inflation's been taken into account. So when inflation moves down from 10 to 3 to 2.5, and then it's going to come back up to 3, 3.5, whatever it's going to get to, then of course it makes it a lot easier for real GDP to grow. It's not that we're necessarily doing that much difference. We've just controlled the inflation, or some would say the figures have been baked in order for that to happen. But I'm not a big conspiracy theorist on the inflation side of things. I think you have to look at the right inflation, but I'll be doing a video on that next week. So I hope you enjoyed this one on the labour market report and the ONS data, and I'll see you very soon. Thanks.